Okay, so here's this week's portfolio. It's composed of 20 stocks like normal. 80% of them are in the US, 20% are outside the US. It looks like from our Morningstar style box, we have about 51% are categorized as value, 38% core, and 7% growth. And almost all of them are large caps. And from here, we can see that we're still keeping a lot of our portfolio in the defensive and sensitive sectors, with the majority of them being energy at 18%, healthcare at 31%, and technology at 16%. And some of the big differences from our portfolio and that of the S&P 500 is we're way underweight on consumer cyclicals and financial services, and overweight in energy. And we have about double the allocation to healthcare. The rest of them are pretty much in line. And looking at a few ratios here, we see that our PE ratio is about 13, and that's about 82% of that of the S&P 500. Our price to book ratio is about 2 times, and it's about 74% of the S&P 500. So we're buying the earnings and the net assets of these companies at a little cheaper rate than if we were to buy the S&P 500. Our return on assets and return on equity are a little bit less than that of the S&P 500. And going over here, our projected earnings per share growth is about 27% lower than that of the S&P 500, and that would be characteristic of value companies, which is what the majority of our portfolio is. Also, our yield is about 82% higher than that of the S&P 500, and that's another characteristic of value companies. And also, since our portfolio is mainly composed of large caps, we see that we're about 20% larger on average than if we were to buy the S&P 500. Top 5 holdings, we have CVS. CVS recently took a pretty big hit, so we're actually increasing our weight in CVS because we feel like it's a lot cheaper. We also have Total at 9%, General Mills, and a few others, and so we can see that we've got some healthcare, energy, and some more healthcare and technology like we found in our allocation.